children are the beneficiaries. The death benefit still passes on income tax-free because the owner and insured is the same and the beneficiary is different, so there's still only two elements there. But if someone else is the payor, then the premiums are considered either income to the owner or as a gift from the person to the owner. So there is taxation there a little bit, or at least the gift could be. So it's just a little bit odd, but we see that mainly in divorce situations. Another situation here is where we have the spouse as the owner. So let's say this time we'll have the husband be the insured, he's the I. The wife is the owner. The husband can actually pay the premiums because it's unlimited marital deduction and gifts between spouses. That's not a problem. But the spouse has to be the beneficiary. So good situation. We still have only 2 out of 3, so no problem there. The next situation is where we see it sometimes, and this is where the spouse is the owner, but they name the children as the beneficiary. Here's a no-no with the unholy trinity. We have 3 different ones: an insured, a spouse is the owner, and the children is the beneficiary. That would, at death, the death benefit would be considered a gift. The next one is if a business owns it. We see this sometimes with people who own their own business and think they can use their business dollars for their own personal use. But the insured is the insured, the business is the owner, pays the premiums, and then the insured spouse is the beneficiary. This is no-no. This is the death benefit, would be considered income to the spouse. Other than that, it would be, there are such things as split dollar, which is the way around this, but most of the time we don't see that. We just see whether they're trying to use corporate dollars or getting money to their spouse. It would be considered 100% income to the spouse at death. The final one is a lot of times where we see irrevocable life insurance trust. Here the main thing is that the trust is the owner, it is the payor, it is the beneficiary. You say, well, isn't the grantor already the payer? Well, no, they actually gift the money into the trust, and the trust pays the premium. So that's the way you always want to have irrevocable life insurance trust. So the way to keep it out of there, just remember the unholy trinity. You don't want all 3 being different. Okay, annuities. How are they taxed? Well, deferred annuities. Deferred annuities have you put the premium in, the cash values grow on a tax-deferred basis. Here, however, it's money out first. Your earnings come out first, not the basis, which is life insurance. It is taxed as ordinary income, no matter how the money grew, if it grew as a yield, as a dividend, as a capital gain, long-term capital gain, short, don't make any difference. Any income out of a deferred annuity is taxed as ordinary income, and if it comes out other than through a lifetime payout before age 59.5, there is a 10% penalty on top of the income tax. Immediate annuities. Immediate annuities are taxed. Each payment is part cost basis and part earnings. This would be with non-qualified money. If it's qualified money, obviously, you have no cost basis, so each payment will be taxable. The one thing that some people don't realize is that after you receive 100% of your basis, then the next payment would be 100% income. So you'll see in immediate annuities things called exclusion ratios. That's how much is not taxed, so that when you're in your 60s, you're probably going to have an exclusion ratio between 30 to 40 to 45, maybe even 50%. When you get into your 80s or 90s, your exclusion ratios can be 80 or 90%. So